You stand up a little bit further.
Good afternoon, and thank you for coming today. My name is Allison. This is Jack, Jeff, Pirmo, and Chris. We are Gonzaga University and are here today to present you an equity valuation on Hecla Mining, which is far beyond what the financial reports want you to know. Although Hecla has many positive catalysts, they also have a great deal of negative catalysts. As a result, our final recommendation came to a hold at a target price of $5.59. Although Hecla is known as a silver mining company, they actually produce more revenue from gold than they did silver in 2015, and they're the third largest producer of lead and zinc in the United States. Hecla benefits from their mining technology, their naturally hedged position, as well as their future growth initiatives. Their mining technology allows them to produce silver at a very low cash cost compared to the competitors. This is especially true with their advanced mining technology at the Greens Creek mine in Alaska. In regards to their naturally hedged position, Hecla produces gold, silver, lead, and zinc. The market prices of these minerals move up and down at different times and at different rates, giving them this naturally hedged position. In regards to their future growth initiatives, Hecla just purchased Montana Ore and Rock Creek. Right now, silver prices are very low, making these two projects a very inexpensive investment. Hecla's best mine is Greens Creek. It's located in Alaska and produced 9.3 million ounces of silver just last year. Lucky Friday is located in Idaho and is home of the number 4 shaft. This recently completed $225 million project extended the mine's life so it now has a mineable life of 34 years. Casa Berardi is Hecla's all-gold mine. It's located in Canada and produced 146,000 ounces of gold last year. San Sebastian is located in the Mexican Silver Belt. It's Hecla's newest mine and produced 4 million ounces of silver in 2016. As you can see, Canada accounts for approximately 30% of Hecla's annual revenues, and the San Sebastian mine in Mexico accounts for approximately 20%. Together, with Hecla's geographic diverse position, approximately 50% of the revenues come internationally and 50% of the revenues come domestically.
While Hecla does enjoy a geographically diverse position, given recent political events, such as the renegotiation of NAFTA, potentially, Hecla will see a large business and operations risk both in their operations in Canada as well as those in Mexico. Moreover, given the limited hedging position of Hecla, as well as the weakening of the Mexican peso and the Canadian dollar, we will see a strong currency volatility for Hecla as well. If you follow the red line, you'll see that the Mexican peso has hit record lows since Trump's election. The Canadian dollar has followed similar patterns. Lastly, with increased EPA regulation, as well as increased land restriction policy, Hecla will see diminished cash liquidity for 2017 and the years to follow. In 2016, global GDP increased by 3.2%. This pattern is set to continue for 2017 and the years to follow. However, China's GDP experienced a slowdown, and this is projected to continue for the next upcoming years. This is a huge economic risk for Hecla, considering the fact that China's economy has been such a driver for precious metal prices. Moreover, interest rates are set to increase for this year, which will decrease the price of gold. Lastly, while commodities overall are expected to fare extremely well for the next year, precious metals will not do so well, as we are approaching the end of our most recent mining supercycle, which saw, as you can see on the graph, peak prices in both gold and silver in 2011. In 2016, precious metals saw a decrease of 9%.
When determining our target price, we used a weighted average consisting of 2 valuation techniques, allocating 80% to our DCF analysis and 20% to our peer multiples analysis. Considering Hecla as a small cap, volatile stock, the DCF analysis will give us a much more consistent valuation. When breaking down our discounted cash flow model, the key thing we wanted to get was an accurate forecast. In order to do this, we needed to recognize the key cash flow drivers, which were revenue growth and CapEx. I'm going to touch on revenue growth on the next slide. And as far as CapEx, how we forecasted that was due to historical company guidance. Going back the last several years, they've been around 150 million, oftentimes underspending. And we realize when they are always looking to acquire mines, this will fluctuate that price. But we feel confident with 150 million going forward in our forecast. In regards to our other inputted forecasts, we use historical figures to forecast those for the next 5 years. Once we were able to successfully forecast our cash flows, we arrived at a terminal year cash flow. And using a 2.5% terminal growth rate with our 7% team calculated WACC, we were able to determine our terminal value. Then discounting this back, we got the present value of our terminal value, and adding in the present value of our cash flows, we could arrive at an enterprise value. From there, we subtracted out net debt to find the value of the firm before dividing by shares outstanding and arriving at our DCF target price of $5.44. As I mentioned previously, the key cash flow driver was revenue. And there's two things I want to point out to you on this slide. The first is how volatile their revenue growth has been year to year over the past several years. As you can see, it fluctuates from negative 33% to positive 19%, back down to negative 11%, and up to 52%. This gives us a great deal of concern for their consistent revenue growth at that aggressive rate that we see in our forecast of 2016 moving forward. The second thing I want to point out to you is why have they had this aggressive growth in 2016, going from negative 11 in 2015? And we came to a conclusion, it's the addition of their San Sebastian mine. With that being said, we have a great deal of uncertainty with the revenue provided from that mine moving forward, giving us an assessed 5% moderate growth rate starting in 2017, decreasing by 0.5% each year after that.
I'm going to briefly walk you through our multiples. Beginning first, we measured our firm value with respect to reserves. Reserves are an important part of any mining company, and we wanted to ensure that was incorporated into our valuation. As you can see, Hecla is much more expensive compared to its peers using this multiple. Next, we examined enterprise value with respect to EBITDA. We chose enterprise value based on EBITDA because it's capital structure neutral, and it allowed us to compare Hecla with its peers without any distortions from capital structure. On this slide, you can see that Hecla has median performance. Next, we chose the price to sales multiple. The reason we chose the price to sales multiple was because it allows us to analyze this stock without being bogged down by a negative price to earnings ratio, which all of these companies share. As you can see, Hecla has a fairly high price to sales ratio. This, when combined with their price to book ratio trading above 1, lends credence to our argument that Hecla is generally more expensive than their peers.
Hecla's corporate governance restricts hedging to 60%. Despite this fact, Hecla enjoys a natural hedge due to production of lead and zinc. Historically, prices for gold and silver have been negatively correlated with the prices of lead and zinc. While this correlation has been less prevalent in recent times, we still feel that Hecla is better positioned to weather downturns in the prices of gold and silver than the less diversified competitors. While Hecla has been able to outrun the decreasing prices of gold and silver with increased production, we're unable to ignore the uncertainties regarding the San Sebastian mine. Despite the fact that Hecla is experiencing decreasing cash costs through increasing use of advanced technology, they remain a company that's fully dependent on foreign sources for 50% of their income. Ultimately, due to these uncertainties, we recommend a hold position with a target price of $5.59. Thank you very much for your time. We welcome your questions.
Great presentation. I just have a question going back, I think it was your slide 5, when you're talking about business risks with the new administration, and then you were talking about the volatility in the Canadian dollar and Mexican. Were you saying that was a positive for Hecla or a negative?
It was one of the negative aspects that we priced into our valuation.
Okay.
So it's that uncertainty with renegotiating NAFTA, as well as a potential 20% import tax from goods from Mexico that creates instability.
Okay, and then what about with the currency fluctuation?
With currency fluctuations, and I asked this question at the most recent at our most recent meeting. While the value of the peso has decreased, this has actually been a good thing on some senses in the fact that it has decreased operations costs, right? Because it's cheaper to operate overseas. That being said, any currency holdings that Hecla has in the Canadian dollar or the peso overseas will be negatively affected, especially at its renting of the Villardina mill in Mexico.
And then I guess when you look at commodity prices, typically they're in US dollars, right?
Right.
So yeah, you're right, it would be a benefit. So you're actually receiving more of a benefit because your revenues are always coming in US dollars and your costs are in Canadian. And
True.
yeah, so answer. I said it for them.
Although a little bit to that hedging, and I'd say that's actually natural hedging. Do they really have natural hedges in place, or is it a market byproduct that there's a low correlation but not necessarily causation to a natural hedge?
I would say it's more of a market byproduct. So when we're saying the natural hedging, what we're really trying to get at is that they're more diversified as far as their metal base. And that is something coming directly from the company themselves, along with our evaluation based on their peers. So as they have transitioned more into gold, which actually has been in their benefit with how prices have been over the past several years, most of their competitors have less base metals is our main point there, saying that they're naturally hedged due to base metals.
So you guys look at comp in terms of how much the CEO and CFO make relative to other industry players, and whether or not their general corporate governance is very good as a shareholder, and then as well whether or not there's been any insider buying or selling by the management team.
There has been insider buying by their CEO. It hasn't been aggressive as of late. We know, I believe it's around 1%, I want to say, is what Baker holds. As far can you repeat the first part of your question, please?
Yeah, so then just in terms of general corporate governance, so in terms of when you're looking at, is their CEO making 1.2 million or 10 million, and what is that CEO make relative to Pan American Silver CEO or some of the comps, like, and in terms of are they really acting, in the benefit of the shareholders in terms of the comp package, where are they relative to the industry?
We did not run a comp valuation to the salaries of the other companies, but we do believe that he is a recently new CEO and that he is acting in accordance with the shareholders moving forward with Hecla Mining.
So you identify currency and commodity prices as two big risks, both of which are hedgeable through financial instruments. How much hedging are they actually doing, and how did that affect your valuation?
They have a 60% hedge on gold with
Corporate guidance.
through corporate guidance. So they have, in the attempts to not diminish any great growth opportunities for gold investors, they have a very limited hedging position. So this is one of the reasons why we found such a risk currency.
And how far out is that hedged?
I believe 12 months.
Did you guys do any sensitivity analysis in terms of, at XYZ gold and silver price that they would be at break even, or if you were to, or if you were to go back, say like a year ago when commodity prices were getting crushed, did they get into negative earnings? And then as well, what's the delta on the upside? I mean, if gold goes to $2,000 an ounce, is it a $20 stock, or did you guys do any play with any of those valuations relative to commodity?
Yes, so they are extremely sensitive to historically silver, more now gold. And as you can see, like you said, a year ago, commodities, specifically precious metals, were down, and their stock had a significant hit at that time frame. I believe they were trading just above $1.50 a share. So in that aspect, we have looked at the charts in accordance with commodities, and as the success of silver and gold goes up, the success of this company will go up. And that's where we're coming in saying we believe that over the next 12 months, we're going to see the tail end of that mining super cycle, having prices keeping to decrease over the next 12 months.
In your DCF model, you used a 35% effective tax rate.
Yes.
So what is their actual tax rate, especially because it looks like they have a fair amount of debt, which would, be tax deductible?
Yeah, so just based off historical average, that's what they were paying on taxes was 35%.
Historically, they do pay an effective tax rate of 35%.
On EBITDA or on actual earnings?
Actual, yeah.
And then in terms of, so it looks like you guys are using, a pretty low single digit organic growth rate going forward. Did you get to that by stripping out the acquisitions and seeing what their organic growth was over the last few years, or how did you get to that 4.5, 3.5 number?
That was just simply based that they can't keep that 5% just with the growth of GDP. And prices lowering. So the 5% was assessed without San Sebastian in mind.
What inputs did you put in to get your WAC?
Can you please go to the website? All right. So it's your basic capital structure. For our cost of equity, we use a risk-free rate of 2.5% with 10-year average T-bill. Market risk premium, industry consensus around 6%. Our levered beta was determined by a regression analysis of the slope of closing prices between the Russell 2000 and Hecla. And we use Russell 2000 to illustrate that small cap volatility.
What time period did you guys do that over?
We did, can you go to the beta slide, please?
Just because I would think that the volatility of Hecla would be far greater than the Russell 2000. You think it would have a beta above one, right? I mean, I'm not saying your data's wrong, it's just surprising.
Yeah, no, I mean, as you can see here, so the correlation, especially if you do 1 year, so we ran daily, weekly, monthly for historical 5-year, 3-year, and 1 year times 12 different betas. Just over the last year, which we've seen the most volatility with Hecla, that's why you're seeing those kind of outliers in the 1 year. Historically, they haven't had as much, and that's why we like how the historical daily average and the historical 3-year average kind of averaged out, giving us our final beta of 0.72.
So how do you reconcile the fact that you valued Hecla at a static price for commodities with your slide that supposes we're going through the downturn in a super cycle? So you're saying prices are going to fall, but you valued it with them flat. So how did you put those pieces together and make those decisions in macro terms versus your micro analysis?
Well, as far as macro terms, we knew that the most recent mining super cycle was a result of emerging markets as well as the increased buying from the Chinese economy. Seeing that both of those have slowed down significantly with latest policy, we feel that both gold and silver prices will reach new lows in the next 3 years. So we think that would explain the decrease in prices.
So did you use those 3-year minimums when you valued, or current day prices?
Are you referring to our DCF?
Yeah, so what commodity price did you use? And if you're saying now 3 years from now is going to be the mid, why did you use that price?
So with our 5%, we're pricing in at commodities at their lowest point. And from there on, we're essentially saying that with other factors playing into the business, we just don't see them really growing aggressively from there based on how aggressively that they grew in this year. That's more of what's priced into that percentage than commodities shooting up, because we really don't know if that's going to be happening in 2018 through 2020.
But what commodity prices did you actually use?
Gold and silver.
At what point?
Yeah, like at what
what
price? Like $17 silver, $12 silver?
For
That's time.
Thanks so much.
Good job.
I guess. Thanks, guys.
Actually, didn't want to step in. Switch the order up on us.
yeah.